Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Cucchiara, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Cucchiara.
Welcome in, Joe Cucchiara with Real Estate Radio Live. Thank you for those that continue to tune in and follow the show. Again, I'll have to kind of do my apology in advance. I'm trying to get back into gear of podcasts and trying to do them at least once a week and back into the mode. So we did, I think the last one we did was from Hawaii and another one. And so we'll continue to do that. For those that want more information, you could always go to RERL-1758.Market. That's RERL-1758.Market. Just a reminder, this show is brought to you by Bundle Select. Bundle Select partners with corporations to offer their employees an online platform for employee benefits related to real estate, lending, relocation. So for more information, you can go to bundleselect.com. And that would be for anyone listening to the podcast. If you're an employee, go to the website and, let your benefits people and HR people know about it. And if you're a benefits or HR person listening to the podcast, go on to the website. We could do a demo for you. Again, it's bundleselect.com. All right, today we're going to do a little bit of a market update with my good friend and partner, Mike D'Ambrosio, is back with us. We had a show a while back. What was it, the two Italian guys real estate, or I forget what it exactly was.
Two Italian guys talking real estate.
That's right. So good to have Mike back. We're going to do a little bit of a market update, and then we have an interesting article Mike brought to my attention last week. We're going to talk about, and part of the title of the show today will tease you a little bit, and we're going to wait to talk about it a little bit later. But is the richest, or is it the wealthiest? Right, the wealthiest city in the world, or is it the United States? I think it's the world, isn't it? Or one of them?
The highest share of super rich residents in the world.
That's the one, the super rich.
Yeah.
I
don't know if that includes you and me, Joe.
Yeah, I was just going to say, it's a good thing we're talking about cities and not people.
Yeah.
I'm not in that category. Well, let's talk a little bit about the market, Mike, because it seems that there could be a little bit of a change taking place here. The environment, most people know, if you've been following the market for a while, it's been just unbelievably hot. Certainly, if you're a seller, you are in the driver's seat. Most people know that, but maybe it's changing a little bit. So we'll have Mike jump in. Why don't you give us kind of an idea of inventory, what that might look like, or what it has looked like the last 60 days or so. And then we could talk a little bit about maybe how you see the trends going in the next 60 to 90 days.
Yeah, absolutely. Thanks for having me on again. And so when I look at stats, we look at Santa Clara County mainly because that's really the heart of Silicon Valley.
Right.
And so right now, from a single family standpoint, we have about 1,019 active properties on the market. And then condos and townhouses is about 548 for a total of 1,577. And that is definitely a number that's up from a couple months ago. It was still hovering under 1,000, which is really low. And to give some people perspective as to what normalcy is in Santa Clara County, we need about 2,500 to 3,000 units to be what's considered a normal market. And we haven't seen that for I don't know how many years. I don't know how long we haven't seen that since we've been doing podcasts together.
Yeah.
So, and the pendings are at about 1,800. And why that's significant is because the actives have started closing the gap up to pendings. Whereas the last couple months, it was kind of like half and half. So you had about half of the amount of actives as you had contracts, which means things were selling so quickly, couldn't keep up with the demand. And then when I pulled up some charts, another just one thing, and then I'll talk about where I see the market now. But, April, May, and June were really, really hot. The average days on market dropped to like under 2 weeks.
Wow.
When it was always hovering north of 3 to 4 weeks.
Boy.
And the average sale to list price ratio of where things were listed to selling, it jumped up like 5% April, May, and June to like 108%. So that was pretty interesting for the last couple of months. Now, that being said, I'm going to contradict kind of the last 3 months into what's going on right now. And it is a little bit slower. I'd say it's a little bit more normal. A lot of people, I mean, everyone, it seems like we talked about it at our sales meeting today. It seems like just a lot of people are out of town. You know, if you're on Facebook, everyone's in Hawaii. I know, you know, and everyone's just, it seems like just things are slowing. A lot of agents in my office are noticing the same thing. I think as things opened up with post-COVID, people are taking advantage of that. And I expect that to probably continue for the next month or so. And I expect to have a really busy fall up until like the holidays. So that's what is going on right now.
Yeah, I would agree with you. I think there's something in the market that you can't quantify right now. And I think it's the culmination of the pandemic and now people really, for the first time, being able to break loose and travel. I agree with you 100%. Well, it's not only us that see it, is that you look at the articles and the papers and the data that's coming together. I just read an article yesterday, Mike, that for the first time, I think either airports or travel in general throughout the United States is at the pre-pandemic levels.
Yeah.
So it's going crazy. And of course, so I would agree. I think that's a part of it, that you can't look back and do history. I mean, I think that, you know, sometimes the summer is a little slower, right? Because people, they take family vacations, and then it's been usually our experience that the market has a tendency to maybe pick back up in August and September. So
yeah, we always call it the summer swoon is kind of what, you know, the beginning. We have graduation weekends. We always see a slowdown around that time, 2-3 weekends in June, where, you know, open house traffic's really slow, things kind of slow down. Then you have vacations, and then you kind of go back into August and things start to pick up again. So that, we didn't really have that last year because there was no sense of normalcy. And now we're kind of seeing that lull a little bit again because things are back to normal. So but you know, there's always the outliers. I mean, there are properties that are still, I had a fixer upper total dump, you know, but it had great views in the East Foothills, had views of the whole Bay Area, and we got 11 offers on it. That was a couple weeks ago. You know, so there are the outlier properties that are still really, really competitive. But for the most part, we're just seeing a lot of people just kind of checked out right now and doing other things.
Yeah, I wouldn't be a bit surprised if this combination of people just wanting to get the heck out of town and finally take a vacation and finally breathe. On top of that, I am starting to read a lot of articles where, you know, people are kind of getting fed up with the market, the buyers, right? Remember that the last time we went through this, there is a certain point where everything kind of comes together, and this could be coming together where the buyers are getting a little burnout, the pandemic's taking a toll, people are traveling. So we'll see. It'll be interesting to see. So do you think maybe the real market will be able to tell by maybe September, October, if it's really had some significant changes because of some of these dynamics?
Yeah, I do. And I think of the combination of, I think we will be able to see where the market's headed in the later part of the year. The early part of the year, it was pretty insane. And then, like I said, we've had this lull, and I do think it's going to be going pretty crazy again. But I think a big part of that is with rates and whatnot. What are you seeing out there with that?
Well, rates are still good. You know, the conforming loans are still right around 3%. Jumbo's about the same. So I would have to say that, you know, the rate shouldn't be scaring people away, I guess, is my point. Now, one of the things I'll tell you that has happened, that it's noteworthy to talk about just for a couple minutes here, Mike, is that in terms of rates, is that a lot of people don't know, but Fannie Freddie slapped these heavy additional rates and fees on second homes and non-owner properties recently. I mean, ridiculously greedy move on Fannie and Freddie's part. That's right. And I don't care who's listening. It's greed. They'll tell you there was risk. It's not risk. They're seeing a huge run up in people buying second homes and investment properties. So what do they want to do? They want to throw something on it so they can make more money. So I'm wondering, you know, I'm not sure if it's going to deter, but it is get people thinking a little bit. It's significant too. I mean, you know, it could be, to give you an example, let's say 3 or 4 months ago, you could have bought maybe a, an investment property with 25% down, let's say maybe a loan amount of 400 or 500 grand. You could have got it for 4% maybe or so. It wasn't, maybe a percent higher than kind of the primary rate, let's call it. And now you'd be lucky to get 4.5, and it's going to cost you 1 or 2 points just to get 4.5. So, that's something to make note about for those listening to the show. However, I did a show a couple of weeks ago how to circumvent that. And so real quickly, I'll let people know, if you're struggling and you're looking at some of the pricing of non-owner purchases or second home purchases, there is a way around it. Let us know, contact us. We do non-conventional financing, which is jumbo financing. Believe it or not, it's a lot better terms. Now you're going to have to produce tax returns and kind of take your blood and do all that kind of stuff like they do on jumbo, but nonetheless, there's some better terms for that. So I don't know if that's a bit of an effect, but there could be something a little bit there. We'll see how that plays out through the end of the year.
Yeah, and one other thing, a lot of people have been asking me. They always ask, we're in the business, right? And they always ask, well, are we in a bubble, or are we in this or that? And and it's a valid question, but I think with where inventory is now, I mean, a lot of the country's in the same situation now with housing starts and how much building that there's not enough building in the pipeline.
Right.
And there's always, and then I think through COVID too, around here in Silicon Valley, there're not going to be any more large housing developments on decent sized lots. It's just not physically possible. We don't have the land for it. So it's all this infill, high density housing, which there's a purpose for that too. I'm not saying there isn't, but there's always going to be a demand for the Willow Glens, the Cambrians of the world with, 6,000-8,000 square foot lots with normal sized houses. And we're just not going to have that anymore. So, there's always going to be demand for that around here. There's always going to be more buyers for that if rates continue to be somewhat decent. And then the other thing is with building costs. And if anyone's tracking that, if anyone's gone to Home Depot lately and seen how much lumber costs, that's going to it's already expensive enough to build for a builder to build around here, just based on land prices and then the prices of the cities, what they charge for permits and all the other stuff. And now you're throwing in expensive material costs. I mean, it's really de-incentivizing builders to build anything. So
yeah,
I think the pipeline for buyers that are going to be seeking standard tract home properties is going to be for a pretty long time. The only thing I can see changing it is if there's a catastrophic situation with the job market around here, which again, I don't see that happening either. So I don't think we're for sure, I can say that, and I'm saying this on record, it's recording, but we're for sure not going to have a 2008. So anyone looking for that, you're not going to see it. Okay, that's just not going to happen. Will there be a dip? Will there be a lull? Maybe. I just don't see it for the really near-term future. So I don't know. What do you think, Joe?
Well, I would agree. I think that's right on. I mean, you and I have been doing this a long time, and we've done a lot of shows, and there was sometimes, and I am proud to say, as a podcast in general, we joke around a little bit, but in general, over the years, we've been pretty good. Of course, we study the markets and we're in the markets every day, so that helps. But we mentioned a lot of stuff when we were coming in and out of that pandemic. I remember some shows we were doing when the pandemic was right in the middle of things, right before it, when everything kind of froze, right? No open houses, no this, no that. And we did some shows about, there could be so much pent up demand when people come out of this, the housing market could go crazy. And sure enough, it went crazy. So there you go. We called it. I'm going to go on record to say that. But no, I don't see any major bubble unless there's something that comes along that we don't know about. And I do think this is not off topic. When we talk now and people ask me, what could be the next thing? I'll tell you what I think could be the next thing. And I hate to say it, but that could bring the markets to its knees temporarily. And that is cyber attacks. Yeah. I think that, I know it sounds crazy, but if, we've seen what's happened, and if a major bank were to go down, or if a major institution were to be brought to their knees temporarily, is it a long-term problem? Probably not. But, what if all of a sudden no one could access money from B of A or Wells Fargo or something temporarily? I mean, that would spook the market, right?
Absolutely.
Electronically, unfortunately, we've all relied on internet access and online transactions. I do 100%. I absolutely love it. But that also brings in an element of risk. And we've already seen some pretty reputable companies that have taken it on the chin. And I'll tell you this, not to go off on a tangent, but there are companies that have been brought down and paid fees that we don't know about because they don't want to make it public.
Yeah.
Because they're afraid that it will spook and it will entice the people that are doing this. So anyway, if you see one of these major
note to self, I'm making a note, take money out of bank and stuff in mattress.
Right. If you see a cyber attack coming, you might want to sell off. No, I'm kidding. Just totally kidding.
Buy gold and silver tomorrow.
Yeah. And you might want a little Bitcoin just in case, because some of the thieves, some of the terrorists, they want Bitcoin.
Yeah, okay, I'll get some of that too.
Anyway, well, with the time we have left, let's jump into this article. It was really interesting. Mike brought it to my attention. It was a great idea to talk a little bit about this. And I think it's they call them the Superrich.
Yeah.
And they have, I'll let Mike kind of give the summary. I guess they have a category, right? And then that's broken down. So maybe give us a little bit of a summary of what the article talks about, and you and I could dive in.
Yeah, so the super rich are considered people worth 30 million or more, and that grew. And there's been a lot of talk on the news about how much wealthy people gained more wealth during the pandemic, and the super rich population grew by 1.7% in 2020.
Okay.
And so the top 10 cities that have the highest density of ultra wealthy people, number one is San Jose, California.
Amazing.
And when you think about what always, people always normally associate that with San Francisco, but San Francisco is on the list. But San Jose, it's basically number of city residents per ultra high net worth individual. So per 727 residents, you have an ultra rich person in San Jose. Then, so the list goes as follows: San Jose, California. I don't know if you pronounce it Basel or Basel, Switzerland. Hong Kong, Geneva, Zurich, then San Francisco, Seattle, Boston, Bridgeport, Connecticut, and New York City.
Wow.
So some of those are pretty obvious ones. Other ones, not so obvious. Like I was surprised at Bridgeport, Connecticut, but when you look around there, I think there's a lot of financial institutions and whatnot in Connecticut. So it probably takes into account a metropolitan area.
Yeah. I know we've been reporting on this for years, Mike, and sometimes I think we have to take a step back and recognize the significance of this. And what I mean is, we just talk about all the time Silicon Valley and, venture capital and the capital of the world and all this kind of stuff. But think about that's amazing. Out of all the cities and states in the United States, San Jose, which used to be, take your choice, whether it was was it apricot farms or prunes or whatever it was. But it's amazing to think that in the heart of Silicon Valley, San Jose has the super rich, the highest percentage, and not so much the aspect of the money and the prestige as much as so what that means is over the last several decades, you've had an unbelievable amount of people that have come to San Jose, stayed in San Jose, grow more wealth in San Jose. And yet, even with the pandemic, and on top of the fact that we see articles every day, Mike, saying that everybody's leaving California, the fact that San Jose still leads that list is actually remarkable.
It is. It's very remarkable. And I think that probably speaks to people leaving San Jose or looking for opportunity elsewhere, and the people staying have found the opportunity and are taking advantage of it. I don't mean that in a derogatory sense. I'm just saying that probably has a little bit to do with, the exodus versus people coming in. And I think it is pretty amazing when you see that I mean, it ranks up there. I mean, even over Hong Kong, I mean, there's a lot of ultra rich people in China and in Hong Kong. So I thought it was really interesting to see this come out. And then, San Francisco, Seattle, Boston, New York, those are ones that I was expecting to see on there. But to see San Jose jump up to the top was pretty shocking.
That's amazing. Well, I mean, again, it's an easy, you could say, the math, and you could quantify ABC, but when you narrow it down and you really, I guess, get as detailed as saying, we could still probably say that Silicon Valley is so unique still to this point. Because a lot of people, we would talk about this. A lot of people do talk about where's the next Silicon Valley, what'll ever happen, whether it be Austin or Boston or Seattle or all these places. People keep saying the next one's coming. It's obvious that it's still here, right?
Yeah.
It's still here.
It's still here. And again, then you look at, from a population standpoint, I mean, I was started thinking, okay, who can afford to buy houses in the area? It's people that are, obviously, I mean, our average price is $1 million, basically like $1.25 million at this point. And, I think you don't have to be making 30 million, or you don't have to be worth 30 million or more to afford a house like that. But then if you look at the high end properties in San Jose, $5, $6, $7 million, you're paying $100,000 in property taxes alone on top of your mortgage payment.
Yeah.
I mean, you got to be a pretty wealthy person to be able to handle that, But then I go up the peninsula a little bit and you think of Menlo, Atherton, those areas with, you're talking 10, $20 million houses, but the population doesn't support how many people this article is talking about. So again, it goes back to looking at San Jose. It's just pretty shocking to see, that there's this amount of people in the area, but it does tie into property values and the job market around here and what type of job positions around here. And then business owners. There's a lot of business owners in San Jose that own small to mid-sized businesses that you've never even heard of that have done very well for themselves. Right. And more power to them. I think it's awesome. Yeah. And I think that's attributing to this as well.
Yeah, no, that's a really good point. It'd be as I'm thinking about this, it'd be interesting to find out, second home purchases, last I checked, were up 80% year over year. And we know part of that was the whole, everybody, I could work from my home. I don't have to go back to the office and all that. That's another topic. But it would be interesting to find out, like, where the wealthy people, or for instance, where they're buying second homes. Does that make sense?
Yeah.
Where are they buying second homes? Is that in Montana? Is it Arizona? Is it Nevada? Is it, Pebble Beach, 17-mile drive? Where
it might be. There's just not a lot of houses up there to buy. I'm thinking Montana right now because my wife and I just started watching Yellowstone, so I'm all about Yellowstone right now, and Montana looks awesome. But
it gets you fired up watching it, right? I mean, it does. Such beautiful territory. I mean,
yeah. Maggie's like, "Well, when are we going to go to look at houses in Montana?" I'm like, I don't know, but yeah, I think we hear of a lot of people moving to. Well, as far as second homes go, I mean, it's all over the place, Joe. I think really it is, but I mean, people moving out of the area too. It's, the Idaho, Nevada, Arizona. It's a lot of the surrounding states from us. So I imagine that's probably where a lot of the vacation and second homes are, and probably more beach and mountain towns for sure.
Yeah, I would agree. Well, we'll see how things develop. So it will be interesting. So to kind of summarize, we have, a market that appears to be, so as Mike mentioned, inventory is up. Would you say that number of, if I remember right, so is it like 1,500 to 1,600 if you include condos?
Yes.
Yeah. So would you say that's the highest amount of inventory since when? Maybe 6 months, a year ago?
Yeah,
or?
I would say so. Yeah. I would say so. I can even see months of inventory.
I'm just curious, is that a trend? Is that a starting trend?
I think as the year goes on, when people start getting re-engaged around here, that number will go down.
Okay.
And then as the year goes on into the holidays, it'll go down even more. So we might see that boomerang effect again into next year, where it's going to be hot to start, just like it was this year.
Yeah. So you could
naturally goes down throughout the end of the year.
That's a good point. If people come back from vacation and they're all fired up to get back to business and start buying and selling homes, then maybe we've seen it before. I mean, that 1,500 could go down to 700 or 800 within 60 days or so, right? I mean, it could
absolutely.
Happen.
We could definitely see that number. Yeah. And I expect it to, especially into the holiday season.
Yeah. Anything else before we close out? You're seeing in the marketplace, or you might want to give people a heads up on, or, I mean, obviously.
I would say if you're an ultra rich person, give me a call. 408. No, I'm just kidding.
FYI, Mike wants to work with the ultra rich. Give him a call.
No, I'd say, if you ever had any questions or, want to talk about the market, where the market's going, happy to chat about that. I do think it's going to be a strong fall. So if you're thinking about selling, and not to say it's bad right now, if you've got the right property and it's priced right and it looks good, things are still selling relatively quickly. It's always, I don't mean to sound down on what's happening right now. I mean, we're still selling houses within, a week to 2 weeks of putting it on the market. So it's not that bad. Okay. So it's still good. It's just not as like this frenzy as it sometimes is. So I want to make that very clear. Yeah. It is still good.
Good point. Well, before we duck out, so for the and by the way, not just the super rich, but anybody looking to buy or sell a house, Mike is your guy. How do they reach you?
Thank you. Yeah. You can call me at 408-630-0101, or my website is mikedsells.com.
Very good. All right. Also, for more information, you could always go to RERL-live.com, RERL-live.com. And for those who want to text or check in with me, 408-838-9060. Always good having you. All right. Do a check-in with me, Mike.
All right, you too. Thanks for having me on. Good to see you.
Okay, take care.
All right, guys. Take care.
All right. This is Joe Cucchiara with Real Estate Radio Live. Thanks again for Mike D'Ambrosio checking in with us today on our show. For more information, you can go to RERadiolive.com. That's RERadiolive.com. Take care. Have a great afternoon.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.